strategies that empower you to achieve your dreams. I'm your host, Eric Peterson. I'm joined by my expert team, Jim and Ryan.
Hello,
Together,
everyone.
we bring decades of experience to wealth management, investment, and financial planning. Whether you're navigating market volatility or planning for the future, we're here to guide you every step of the way. Let's dive into this episode. Did you just get your tax bill? Are you tired of feeling like you work harder every year just to write a bigger and bigger check to CRA? Well, today we're going to talk about a legal way to reduce that tax bill that isn't just put more money into your RSPs. I want to introduce you to our guest today, Dan Pembleton. He's got an MBA, he's a CFA, he founded Excelliant Capital Management back in 2002 and has spent decades managing institutional and alternative investment. He now leads the team behind Pavilion Flow Through Funds focused on the Canadian resource sector. Dan, welcome.
Thank you very much. I appreciate being here and having my product featured.
Excellent. Well, start by telling us a little bit about your background. What kind of started you out and ended you now doing Flow Through with Exilian?
Um, I started. I'm one of the, I guess, one of the lucky people that knew from a very young age the direction I wanted to go in career wise. So I'd always been interested in financial markets. Small fun fact, or maybe not so fun fact, is my first foray into financial markets was doing a project. I think I was probably 11 or 12 on the gold price back in
Oh, wow.
1979 or 1980 or something like that. So kind of come full circle. But went did the usual stuff, going on this kind of a track in school, economics and business in my undergrad, and then an MBA, as you mentioned, and CFA. I started, formally working in the industry as a bond trader. Did that for nearly a decade with RBC Dominion Securities, and I was vice president global money markets by the end of that, and then started Accent Capital in 2002, and my specific reason was to take things that I had learned both in working in the industry and through education, and create financial products geared towards retail investing. Kind of knocked around with a few different ideas, much of them centered around commodities and commodity type companies. And then in 2008, started the Pavilion Flow Through Fund when I had, stumbled upon in many ways the tax advantage of flow through shares, and I combined that with my commodity and mining experience. So yeah, put the two together, came out with a Reese's Peanut Butter Cup.
Interesting. Yeah. Well, at 11, I'm envisioning that Michael Scott wearing a suit at age 11, doing forex gold analysis from your little desk in your room.
Yeah, yes, well, yeah, uber nerd. But there you go. That's
Yeah.
yeah, that's how you get started, I guess, sometimes.
No, that's interesting, and it's again, commodities are unique in the whole
Mm.
marketplace, so it's always fun to find someone who's that that's their specialty. Well, for the people watching, by the end of this episode, you'll know what this strategy is, how a normal investor can use it, what the risks are, and how to find out if it fits your situation. So let's dive into it. People are starting to. A lot of people don't realize that their biggest expense in a year often is tax. It gets deducted off before you get your paycheck in most cases, and so most people, when they don't realize that, don't think about that, and they don't know that there's an option that goes beyond the traditional TFSA or RRSP. Um, can you share an example of how this would apply to someone who, say, was in a tax bracket around 250K?
So yeah, it would work. They would they're in a 250K tax bracket. They're paying a significant amount of their money in taxes. 120 $25,000 basically if you're in the 50% plus tax bracket. And so they've certainly in that situation probably used up every other program that exists. They've probably done RESPs, RRSPs, TFSAs, all of that, and they still have a giant tax bill. And so, what where flow through comes in, and it's very very flexible, is these people can also do an investment in flow through, and when you do that, you get two sets of benefits. One is what's called a Canadian exploration expense deduction, which is equivalent to 100% of the money that goes into these mining exploration companies to mine or to explore for resources, and you get investment tax credits on top of it, depending on what type of mineral they're looking for. If it's critical minerals, they'll get a 30% investment tax credit. Everything else gets a 15% tax credit. So you put these together, it becomes an enormous tax advantage, and it's very very flexible because there's no limit on the amount that somebody can use other than what would be suitable from an investment point of view, or whatever their own risk tolerance is as well. But the government doesn't say, oh, you can only put 18% of your income in, or $7,000 a year or whatever, like the other programs have. So it's very flexible that way. On the other side, on the other end, on the way out, the money that's returned is taxable as a capital gain. So it's extra beneficial. You have the deduction on the way in, more than what you actually put in, say 115 conservatively, and on the way out it's taxed as a capital gain, which is, as most people know, is a half rate tax. So significant tax advantages for doing this program.
I think I
So,
just want to, Eric, sorry, I just want to pause here for one
oh,
second.
okay.
Just for everyone who is watching and listening, uh, whatever you hear today, please don't take this as any form of investment or financial advice. All right, so if you do have any additional questions, you want to find out more, we encourage you to reach out to Eric, who's registered to offer these offerings, or myself. So please don't take this as financial advice. This is just more of we're sharing an opportunity. But if you want to find out more, just please reach out to us. All right, Eric, you can take over again. Sorry, just had to do the legals. Get that out of the way.
Yeah.
Good
Thank you,
plan.
Jim. Thank you,
Yeah.
Jim. That's why there's more than one of us. So Dan, kind of going back to the tax side of it, a lot of people, when I bring up anything to do with some sort of a tax strategy, a lot of times, especially their accountants are the first ones to come along and say, "Oh, this sounds like some kind of tax scam, and CRA is going to come down on you, and you'll get assessed back, and everything you did will be work for nothing." How do you explain that this comes from something that's more solid than a passing scheme?
Sure. Yeah. And that is, we still run into that from time to time, even though it's certainly flow through has been a little more mainstream in the last 10 years or so. But the way we address that is a couple of ways. Um, it's on the CRA website. There's forms. There's also guides on the CRA website, and also for the issuing investee companies as well, on how they can use the program. The other thing is, in the recent years, there's been, as they've enhanced the program with critical minerals. So in 2022, there were lots of news announcements around it, how the government at the time added an extra incentive for critical minerals, and actually just a few, or I guess maybe 2 months ago now, they added more minerals to the list of critical minerals. So there's a lot of for anybody who looks into it, there's just it becomes quite obvious that it's a system that the government put in place specifically as kind of an industrial policy, really, to encourage investment into the mining sector, because you can't build mines unless you have an ore body that you need to pull out of the ground, and finding those ore bodies is one of the trickiest parts of the whole exercise. And in order to get the capital in, the government said, you know what, we're going to try and reduce an investor's risk. And by doing that, we're going to give them some big tax incentives to do that, so we can draw their capital in and help get these minerals found, so we can go mine them.
Interesting. Yeah.
So, question, because I know we've talked about the strategy, and a lot of people have never heard about flow-throughs. Eric, I've heard you say to people that flow-throughs was actually available before RSPs were even introduced in Canada. Is that correct?
Yeah, that is
Right?
true. Yeah.
Okay.
Yeah.
So this is like how many years? Like I don't even remember when the RSPs were introduced into Canada.
Yeah, I don't focus on that date, but it was, I know
A long time.
it was a long time ago. The flow through showed up in 1954,
Okay.
formally in the tax, and that at that time it was geared more towards corporations, so corporation to corporation kind of a tax program, and then it was broadened out. Now that data escapes me at the moment, but it was broadened out, 15 years or so, or 20 years later, to include individuals on their taxes.
And before I
And
forget
I
as well,
just-
just one more thing. Anyone who is watching live, you can go ahead in the chat, ask any questions. Right, Dan? You're okay to ask any questions?
Absolutely,
Well,
yeah.
Well,
Yeah.
specific to your offering. So you can go ahead and reach out to us that way. And if you're watching on YouTube or LinkedIn, you can also go ahead in the chat feature in those platforms, ask a question, and we'll try to get Dan to answer any of the questions you might have. All right, I'm done.
So just out of curiosity, I looked up RSPs and they came in 1957. So yeah, the flow throughs preceded it by a few years. Yeah. So in plain language, then we talked about the tax mechanical part of this, and we'll get into that in a little bit more detail in a bit. What is the actual investment? So all benefits aside, when I put in $1, where's that dollar going? What is it doing? Who are you investing it in? How are you investing it?
Sure. So the way it works is we put together a portfolio of companies that are exploring or developing. Generally, they're in the early stages of mine development. So they're exploring for minerals, or they've made a discovery and they're trying to make that discovery larger. And we do that. We do that by talking to management all the time. We're certainly seeing a lot of companies come through. We're always looking for new deal flow, and we look for management teams that have a strong background of success. And with the view of, if I was hiring them, would this be the team that I would want to put in place to help me go find minerals? We look at where they're exploring and what the property's like. And we look at what the surrounding infrastructure is, kind of as a forward-looking element, as if we did find something, is it in a place where we could actually get something built? Because there's no use finding something that nobody's going to either allow you to get built, or is so far away that from anything that you couldn't power it or get the metal or the ore processed. So we look at all of these elements, both very current and kind of forward looking, and we put together a portfolio. We generally do this. We start with a major macro look and say, okay, how much of X% commodity do we want in this and in the other? And then we look for obviously we keep a or maybe not so obviously. We keep a wish list of companies that are in different areas, and then we pull together a portfolio. And this is we don't buy shares on the exchange. So what ends up happening is we buy from treasury. That's one of the stipulations that when you're doing flow through shares, it has to be new capital. So we're buying from treasury, and that just, we find the intersection of when those companies need money, and we have money in the fund, and we come to an agreed price, and the deal is done, and that we assemble anywhere from say 25 to 35 companies into any one portfolio. And each year is a separate fund, I should point out as well. So we start with a clean slate every year because it is a tax product. We have to be completely invested by the end of the year. So it mandates that each fund, practically speaking, is one per year, and they stand alone from that point on.
I should point out too. I know Jim has a question,
Yeah.
but the deadline for these is not like RSPs where you can put into you can contribute
Right.
up until like March, April. With these, you have to be contributed before December 31st, and oftentimes Dan wants to spend Christmas with his family, so it's got to be the deadlines are before that. So
That's right.
keep
Whether
that
they
in
like it
mind.
or not,
Yeah,
I'm
yeah,
showing up for Christmas.
yeah. Jim, you had a question.
So I actually have a question from Kevin. The question is, are flow-through funds limited solely to mining?
They can include solar or wind type projects. We haven't, I just haven't found any that really fit. Effectively, they are limited to solely mining. They used to include oil and gas, but that was eliminated at the same time, same year, 2022, same year that the critical minerals deduction or extra tax credit was added. The oil and gas element was eliminated from them.
Kevin Day stole my question. That's exactly what I was thinking. So, Kevin, good job on that. I guess hearing all this, and I may be skipping ahead. So, I'm just a regular investor, right? Listening and, making regular pay, or perhaps maybe even a small corporation. Can I participate in it? Or it sounds, because often when you listen to Instagram and all these social media, it's like, if you don't have $1 million or less to invest in, well then, sorry, too much. But I think that's where we come into play with this podcast. Is like we're trying to introduce other options for people. That's why Jim gives the thing. Don't take this as advice right away. Every person is different. So I guess really is, do I need millions to invest in this? Or do I have to be an insider? Or Dan, are you my insider for knowing the great mining industries? So can we invest in, or anybody invest
Yeah,
in it?
yeah. The short answer is yes. Our fund has a $10,000 minimum, which would be accessible to most people. And it's what's called an exempt market fund. So there are certain income qualifications and or asset qualifications that are decent, but not so exclusionary to people. So that would be something that anyone would go over with their investment dealer. But from our point of view, what I do know is in our funds we have people from all walks of life. Really, we have nurses, we have lawyers, we have firefighters, we have police officers. We have them all, and we also have business owners who have had transactions where they have several $1 million worth of income in a year. So a very broad range of people. And I do like to, I kind of, liken flow through as kind of the Swiss Army knife of tax planning, because it is quite useful. In it has a lot of flexibilities built into it, and yeah, I think in it can often be an enhancement for many people's financial plan. But that's something, each person is an individual, and this is not advice. So, but they should seek out advice. But I think, yes, if you have a tax bill that you think is significant and or painful, probably worth getting some advice and seeing whether this fits.
And again, I'm going to steal from Jim raising his hand because again, Kevin and I are linked right now. Of all the questions that I have following too, is one of the questions is, can the investment be held in a trust or a holding company?
It could be held in a holding company. It can't be held. Well, it can be held in trusts. Actually, yeah. It can't be held in RSPs or other government program trusts. But if somebody had a family trust or other type of holding, then this can qualify for that. Obviously, can be held in corporations as well. Some of those things can affect the tax effectiveness of it. So you would want to get into the specifics of it to make sure that you were getting the benefits that you needed, and that it was providing the benefits that you expected. But yeah, it has a lot of flexibility to be held anywhere you want.
Yeah, follow on to that, because I was going to go to the RSPs next. I always get the real clever guy that comes out to me. Oh, well, could I contribute this to my RSP and get a double deduction, get all the tax benefits, and have the growth be in the RSP? Tell us a little bit about the problems there.
Yeah, the government saw that coming. So so it's really, what it has to do with is the because the underlying is a limited partnership. In order to structure it tax efficiently, it's a flow through vehicle. So the the deductions and all the expenses and things like that are flowed through to the investor so that they can deduct them from their income. And once you put something into a limited partnership, then it won't qualify. A private limited partnership won't qualify for RSP, being held in an RSP, and so you can't get the double deduction. Plus, if you even did that, then you would trigger the capital gains immediately on doing that. So there'd still be a benefit if you could, but they they don't let you do that.
Yeah, yeah. And so the same with tax-free savings account, RSP,
Right.
LIRAs, these have to stay out of all of those registered
Hmm.
accounts.
Yeah.
Um,
Yeah.
so for the people listening, think of this as something that sits beside your RSP or TFSA in your non-registered account, rather than being one of those registered vehicles. And this is specifically aimed at that ugly tax bill. So one quick question before we move on, Dan. Um, could I make $500,000 this year, say, could I buy enough of these to completely take my tax down to zero?
It would, I mean, it gets very specific. It depends where your income comes from and how much is you would we haven't specifically done that kind of a problem solving issue. Most people of that kind of an income have multiple sources, capital gains, dividends, things like that. You'll get to an alternative minimum tax point at some point, usually, but you will have you before you get there, you have significantly reduced your tax bill. And yeah, but again, that speaks to the individual nature of it. There is an element of tax planning in it. Obviously, we're portfolio managers. We don't do the tax planning. We just provide the tool. But it's people with that kind of an income, in my opinion, they definitely should be looking at flow through and learning about it at the very minimum, to see whether it's something that they could use, because you run out of tools very quickly for tax planning when you get into those kinds of income areas.
Yeah. No, I wanted to bring up the alternative minimum tax because I do have clients that will regularly ask, can I do this? And it's like, well, you can, but at some point CRA is going to step in and say, you're not paying enough tax, so we're going to assess you a tax, and that's the alternative minimum tax. So just so people have a bit of an idea that, yeah, there's a lot more complexity to just reducing it down to zero. So now I want to move on to some real life examples. I'll kind of use one of a client I just had recently for the personal side. And then Dan, if you could think of a corporate situation, because I know these can apply corporately, but it's a little bit different. So if you could comment on that. But first, had a client, earned about 200 to 250,000 a year, received a bonus of about 200,000 that was tied to a bunch of corporate changes and bonus to how a sale was happening, and all of a sudden went from paying a large tax bill to paying a very large tax bill, and again, RSPs nearly maxed out. I mean, we did use some RSPs, but at the same time, you get to a limitation on that. We ended up bringing in about a $50,000 purchase of the flow-through shares, provides a significant tax relief in all of this. Corporately, how would a scenario work for someone, and what of those credits are available or not available to a corporate owner or a corporate buyer?
Yeah, corporate purchases of flow through are a little more restricted in the amount of deductions that they're allowed to have. So what ends up happening is the example that you talked about at 250 or 450, the individual gets those investment tax credits I talked about, those which are super powerful because those come off of tax owing after somebody's done all of their calculations and they have an X amount of tax, and these investment tax credits can be used to directly reduce the tax owing. Those credits are for individuals only. So a corporation would not receive the investment tax credits that are associated. They receive the CEE deductions and reduce the corporate income that way, but they don't get the investment tax credits. Now, on the flip side of it, as I mentioned, when investments are sold, it's a capital gain, and or what I should say, when money is returned from the fund, it's a capital gain, and that is in a corporate circumstance, which is great because that also is allowed to increase the capital dividend account. So when you increase your capital dividend account, payments from that account can be made tax free to the shareholders of the corporation. So there's some nuanced benefits. Again, I don't want to scare people away saying, "Oh my gosh, this is so complex." It is on a podcast, but it's not quite so hard when you're sitting down with somebody and you have a spreadsheet or a tax return in front of you. It becomes fairly simple, but it's useful in both instances. I have a corporation. I don't choose to invest through the corporation what I do because I don't like to lose those personal. I take the money from the corporation as a bonus to myself, and then invest, so I can collect those investment tax credits. But that's my own situation and my own preference. Other people might have reasons why they want to do it. What I can say is it's very flexible to either way of doing it, and worth pursuing.
Yeah, Jim has a question as well, but just to follow on with that corporation, an example, I have a client who has a considerable amount of investments in his corporation and is now on the edge of retiring. This is an excellent mechanism to help trigger some of that or move some of that out without the. So I mean, yeah, keep in mind, anyone who's listening, that that's Jim and I and Dan and his team. We're here to help you navigate that. So any complexity you might think exists, we make it easy, or that's our goal, anyways, is to make it easy. Jim, you had another question.
Yeah, well, I mean, we're talking about the tax benefits and the tax strategy. What I can say as an advisor, years ago, labor-sponsored funds were quite popular. Many people invested. There was a tax benefit to them. They also were looking at their statements and saw that there was poor performance, but they forgot the benefit that they received from the tax side. So I'd like to talk about the investment component, right? In terms of, yeah, there is a tax benefit. People will forget that if there's underperformance. So can we talk a bit about the investment itself? And there are risks involved with every investment. There's no guarantees in anything that we're talking about here. But maybe you can touch a little bit more about the actual investment itself.
Sure. Yeah, and again, cautionary statement is that if I'm going to talk a little bit about historicals, and of course that we can't guarantee or imply that those kinds of returns are we can duplicate those on the go forward. But if we don't talk about them, we don't have much to talk about. So, so
Right.
we have to go with what we have. So the way I created the fund actually was quite different from how people had looked at flow through before that time. And what I did is I studied what some very astute mining investors had done in their own portfolios and how they looked at it and what was going on in flow through at the time and how people were using it. And I noticed a disconnect in the investment thesis between the two. And so what we did is I created a fund that had a longer time horizon, and we're kind of what we call a 5+1+1, which is we target 5 years, and if needed, I can extend it by an extra year if there's some circumstances that are either extra beneficial for going an extra year, or we're trying to avoid something that's detrimental at that one date, and we can go another year after that with the permission of the investors. So and that is in contrast to, say, other funds that were out there at the time, which were doing anywhere from 8 months to 24 months. And so when I put together a portfolio, I'm looking at putting together a portfolio that will provide, the goal is to provide positive returns on an absolute basis over that 5 year horizon. And the taxes, the tax savings, and the incredible tax benefits, well, that just comes with the program. So my only job as a portfolio manager is one to invest in qualifying investments, make sure it qualifies for the program, and then the other one is build the very best portfolio possible to create a return over that 5+1+1 time horizon that we have. And over the, if you looking at our what we call our absolute returns, which we do on on an after tax basis and on a cash on cash basis. If you look at the cash on cash over our funds that have closed, we've returned a little over 100%, 105% roughly on average over our performance history, cash on cash. And so when you dive down below that and you go, okay, so people got those incredible tax deductions, and they also did get their money back plus some. So it was, and I look at that as being particularly beneficial. And that most of that track record came during what was a very significant bear market. We started in 2008, so my timing was probably not the absolute best in terms of when to start this whole thing, but we started in 2008, and it worked out very well. And I think the macro picture right now is far better than what we started with. So yeah, that's a bit on how it works. That I look at it as an investment first, and the tax benefits just come along with the ride. And with that kind of focus, I believe that helps us create a better portfolio, which in turn then helps people keep all those tax benefits. Because I think
Right.
what you had said, Jim, was sort of like, oh, great tax benefits of that other program,
Yeah.
but you didn't really get that economically farther ahead because you ended up losing money. That's not been our experience in the now 17 years of running this fund. It's not the same for every year. Those are averages that I talked about. We have ups and downs, but for people who invest consistently, that certainly shows the strength of our program.
Yeah, what I do like, you guys do share every one of your funds, the return with the tax benefit, the return without the tax benefit. If anyone is interested, who's listening to see and really discuss more about it, that's part of what we bring to the table when we start talking about the information involved. But again, always want to say, past returns do not indicate future performance. So keep that in mind. And there is a lot of really specific risk in these early stage resource companies. Like they you can do a lot of technical work, but they can still start digging a hole and not find what they're looking for. But again, the managers that do well, and that's one reason why we've chosen to work with Exilian Pavilion.
I have a
So
question actually.
yeah, go ahead, Ryan.
Excuse me if I've forgotten this because of user error in computers, but we've talked a lot about RRSPs and how they kind of coincide, but a lot of our clients are 71 plus, they're retirees, right? How does this play, especially for a client that is potentially earning a good pension, has maxed out their RSPs, does this still fit their model then too?
It certainly from a tax point of view, it fits. It can fit very well actually, because like you said, they run out of options, and in some cases they're very comfortable and have more than enough assets, and are really actually looking towards the next generation, and the best way to help out the next generation is make sure that this generation isn't taxed too heavily for these later years. And yeah, flow through has been used by people who are older, and also helps manage those income levels, because old age security gets clawed back at pretty low levels of income. So even a small allocation in flow through for some of these individuals can actually, when you look at what the alternative, if the do nothing versus do flow through, when you add in some old age security plus all these other investment tax credits, can get very compelling in for the right situation. Again, they do get very specific, but it's important. The other thing that I didn't mention before, which is handy and might can help some people, if people have tax losses, old tax losses that they're carrying along. Because this comes back as a capital gain, it can also be a way to use up those tax losses a little much faster than you might on another. You might not want to sell certain parts, or even be able to sell certain parts of your portfolio to make up a tax loss. But if you have some flow through, which comes back as a capital gain, it can also be handy to soak those up as soon as possible, because then a tax loss, although painful to have collected, it becomes a bit of an asset when you use flow through, because it helps you keep more of that after tax cash flow when capital gains come back.
Yeah. Jim, you had a question?
Yeah, because the hamster woke up and the hamster wheel is spinning now. So, so
Uh-oh.
maybe Dan, I'm gonna maybe share an example and let me know if it would work in this example. So we have a lot
Okay.
of individuals who unfortunately are leaving their employers. Many of them may have a defined benefit pension plan, and they choose to take the commuted value out. And out of that commuted value, you have the portion that you can roll over into Lira, but there's the unlocked portion that if they don't have an RSP room to contribute it to, they're getting hammered in tax. Would that be a scenario where this would help them in reducing that tax bill?
We've had many examples of that in this, and in fact, I've had a family member who used just that because they they commuted a pension. They had a defined or a defined contribution pension, no RRSP, significant RSP deductions available, and the yeah, and it, they used this to save a significant amount of tax on that basis. So this is also a tool that can be used again under advice, of course, but I've seen it used, and it has yeah, it's more common than you would think.
Okay. Is liquidity one of those risks that we have to be concerned about?
Liquidity is, yeah, certainly. That's part of kind of making sure that the investment in anything is right sized. And it's good that you mentioned liquidity because many funds have redemption abilities and things like that. Flow through does Pavilion Flow through does not.
Okay.
We don't offer redemption, and there's many good reasons for that. Primarily is because these are these are illiquid investments is the underlying part. So you do need to do it on a portfolio basis, and although I'm biased, but you do kind of need a sector expert to be able to manage the exits. The exits are probably, I would say, are probably the most important part of flow through investing, because you can take a really well thought out investment that's been reasonably successful, and you can destroy a lot of value with a poorly timed exit. So it's so we don't allow redemptions, because what ends up happening in that case is my hands would become tied, and if I get a redemption notice, I have to sell. What I also noted is that if you look at sort of behavioral finance, people tend to be their own worst enemies in these kinds of situations. So it's I think it's better for people's long term wealth to be able to have some of these exits managed for them.
Yeah, and to kind of carry on both what Ryan and Jim had said, suitability for these kinds of investments is really important. There's a lot of times that they really can fit, but they fit just right in the situation that they fit. So if someone's the kind of investor who panics when something moves, this is probably not the greatest place to be. But at the same time, that's the beauty in trusting in the manager. If we have a good manager, they're thinking not emotionally, they're thinking logically and analytically, and that's the key. When it comes to the private market, private equity, the exempt market, almost everything we consider it to be completely illiquid. Again, it has different attributes. That's one of the attributes you take. So when we set up that suitability, we look at a client, how much of your portfolio goes into the exempt market or into something as specific as this really becomes a conversation that is unique to every individual. So I want to kind of step it now into some of the other strategies that Exilient really talks about, and one is laddering. Can you tell us about laddering and how an investor would benefit from laddering?
Yeah, good. I'm glad you asked, because that's actually my favorite way. Although flow through and Pavilion, like, super flexible. If somebody has a one time or short term tax issue over a couple of years, super flexible to help with that. But I think the the most useful and the highest best use of flow through is a person who can use it annually and plans to use it annually. Um, and what the laddering is, someone plans to climb the flow through ladder, and you project out. It's like, oh, I'm going to do this for 5 years. And what you do, you buy your first year, you get a significant tax deduction. You go into the second year, you buy it again. By the time you get to the third year, your cumulative tax deductions of your previous investments get to be, sort of notionally are a funding source for your ongoing investments. And then, because we don't wait until the end of the 5 year term to return capital. We start returning capital really as soon as something happens within the portfolio that makes it practical, whether controlling risk in some way, taking profit on something else, or eliminating something that we no longer think is worthy of having in a portfolio. We sell that, and I like to say we return when we accumulate enough cash to return a useful amount. We'll send it out, so people start to see tax cash coming back, as early, sometimes as in the first year, but usually in year two. And so in the laddering process, your tax refunds and the cash you're getting from previous investments starts to catch up with what your notional amount, if say it was, 25 or $50,000 a year, it starts to catch up with the amount of capital that you're allocating towards the investment, and it starts to become a self funding type of program. Of course, there are ups and downs in the markets, and that can change things slightly on that, but you get a lot of help. And when I think about, if you think about this, one of the ways I personally use it is I use my flow through to bring me completely out of the highest tax bracket, bring my income down, so I'm completely out of the highest tax bracket. I live in Ontario, and significantly into the tax bracket below that. And I do it every year. And the net result will be that my average tax rate over my working life, or remaining working life, is much lower than it would be if I hadn't done that. So, and that's, again, as you mentioned at the beginning, taxes are actually the biggest expense that people have. And by doing that, I believe that I'm doing myself a great service in terms of being able to keep more of my money in my own pocket over time. And so that's where laddering comes down and really helps, I believe, lower people's average tax rate over their working life when used consistently and for a long period of time.
Yeah, no, that's great. Jim, you had a question?
Yeah, hamster wheel again. So can this, or has this been used as an estate planning tool to lower the estate's tax liability?
It's a tricky one, but yes, it has been,
Okay.
because there is a final. Everybody has a terminal return, and so, but I haven't. We haven't done it with an executor. I haven't tested whether an executor could sign an investment. Where it has been used is people who have anticipated their terminal return. And one other feature of flow through is, you can carry forward these deductions. So you can carry them forward, some very long, but 20 years, you can basically, if you would not be offside by carrying forward things forward 20 years. And so if you had a carry forward, let's say you're whatever in your 80s, and your health is maybe not as good as you expect, you could, to help out, again under advice, but to help out your executor, and on the final terminal return, you could bank some deductions that could be used as well. So yeah, this is something, but I haven't seen it done nor tested it on an executor level, whether an executor could make that investment decision. That might be more of a securities law than a tax law issue, but I haven't tested it.
Okay.
Interesting. Yeah. So we've kind of gone through a lot of the details. Let's go to what tools do you have that help people to understand what it is that you do? I'm kind of referring, this is a bit of a loaded question, your calculator, some of your information pieces, the offering memorandum materials. What do you have out there that will help people to understand how this can affect them?
Yeah, I think the first the one of the first places that people could look is to look at the tax calculator and see if their situation, even if on that basis, again, it's a simplified tax calculator, but it's notionally correct. But see whether it even interests them in their rough situation, just sort of a rough outline. And then once that's done, I think people should always work with advisors. So, but there's a lot of information on our website, of what flow through is about, and there's booklets and things like that. But I think the best source of information is to contact an advisor and just have a conversation about it. And we spend a lot of time training advisors and bringing people up to speed, and you could probably even potentially get a webinar by one of my staff or myself to walk through people on an individual basis or a group basis, just to help educate people as to how it can be used. So there's a reasonable amount of information available, and we're not in a rush to bring anybody on as an investor. We want happy investors, because that makes my life a lot easier. So we want people to be fully informed. So we take our time making sure that everybody has all the information, is completely comfortable with what they're doing. And we want raving fans at the end of the day. And so yeah, we take a go slow approach in onboarding people, for sure.
Well, that's a great answer, because I know a guy who can help you figure that out. So I think we're kind of getting close to the end. I'm just looking through my notes and making sure we covered all of the key things. The laddering is really important. Again, it's that rolling. You build up a machine, especially when you start reinvesting returns. It just creates a conversion machine that really turns your income tax into capital gains, which is great. You can continue to find just the right amount for your overall portfolio. We want to make sure you're not over allocated in something like this, because these, exploration is higher risk. That's why that benefit of the tax function is added to this. But in the end, there's been very seldom scenarios where I've seen a scenario where I think that it wouldn't be appropriate. In most cases, I think there's room for some. And then, yeah. So what's your web address, so people can go and do some looking if they're interested?
That's a great question, because it's not something that I usually answer. I have it all on my tabs, so I haven't.
This is why I rely on
Okay.
Jim too.
Yeah,
What's our phone number, Jim?
yeah,
Yeah.
So
Now I'm rushing to find it myself.
I
But
think we're pavilion. I think we're pavilionfund.com, but chances are, I think we bought every combination and permutation of pavilion. So if so that nobody could squat our name address. So I think they'll all get there. But I think if I had to recommend it, it would be like get a hold of Eric,
Yes.
and then he will help you get the information directly. But yeah, we're out there. That's
apparently we
funny
both
that
like
that's
the
the
same
hardest
guy.
question I get all day.
Yeah. You don't sit there looking at yourself in the
It's
mirror
like,
all day. Is
yeah, what did
the
you have for
answer?
lunch yesterday? I
Yeah. So yeah, for anyone listening, we call it a flow-through tax impact snapshot. Pavilion
don't know.
maintains an annual calculator because the credits do change periodically. How that affects your tax in different provinces really can change. And so it's a 20 to 30-minute chat where we go over how it fits your situation, what the benefits could be. And then from there, our goal is to educate you enough that you feel confident in either making a decision to go ahead or making a decision to not. And really, that's our goal, is to give you that education. Jim, you had a comment?
Yeah, I've got a couple of questions here. So,
Okay.
David's asking if we can send an email as a follow-up with a web address.
Yeah.
So David, we are going to send this out by way of our YouTube video, podcast, blog post, e-newsletter. So what I'd recommend you do is if you want to go to tvhfinancial.ca, register for our Money Mindset Mastery blog. That blog, we usually send out all the links to all the various recordings. So if you want to listen, you can listen. If you want to watch it, you can watch it. And then let me just see here. Jens Alfonso, she gave us the actual address. So
So Dan was right.
pavilionfund.com. So thank you, Jens,
Yeah.
for that. So that's it in terms of questions. So I think we're definitely approaching the 1 hour mark. So as I'm kind of winding this down, or maybe Ryan, you can kind of send us home here in 1 second. If you're still watching and listening and you have any more questions, here's an opportunity for you to ask any final questions. But as I mentioned, we are going to send out this recording. So if you can go to our YouTube channel, podcast, we're on all the major platforms. Again, there will be a blog post and an e-newsletter. So if you want to sign up for our e-newsletter, that'll go out probably by Friday, so end of this week. But Ryan, how else can people find us?
All of our social media pages, of course, looking for me to dance apparently along the way. So Facebook, LinkedIn, you mentioned tvh.ca, Instagram, TikTok. I think that's about it. And Jim usually takes care of the phone number because I always forget it. So
647-727-4668.
yeah, and again, like this has been a very interesting podcast because bits and pieces of this I never knew about, and I felt like with mining and stuff, it's like you're being part of the old Klondike. Instead of doing all the dirty work, instead allow Dan and Eric to do a bit of the dirty work. And I think it's important, again, a reminder that this is not some magic ball, which is still on Amazon back order. But if you honestly feel like the tax bill is the dark side of your financial story, maybe it's time to talk about this as a potential play for you. And just remember, every Jedi needs a solid plan, so may the Fourth be with you on this day. So
I knew you were going to squeeze that in somehow.
Well, and listen, the other thing I'm going to add too is if you're an accountant and you're tired of hearing your clients complain about the tax bill in the end of April, just
Hey, Dave.
give Eric a call.
hopefully Dave's listening. Dave.
Yeah.
Yeah, because it is important. We do work with our clients' tax advisors if you have one. If you don't, we do have a really good tax accountant in TVH Group, so we can help you solve some of those challenges too.
Yeah.
But to wrap up, if you do have questions, Eric at tvhgroup.ca is my email, and you can call me at 780-306-7359. I'm based in Edmonton, but Jim and Ryan are in Toronto. Pavilion is in Toronto. We work all across Canada. We're registered in most provinces that people live, so give us a call. And in the meantime, if you want to stay tuned to these kinds of things in the future, tune into Money Mindset Mastery Podcast. You'll find us on YouTube, Spotify, Riverside. There's a whole bunch of them. Ryan listed them off, but we'll let you guys get back to your day and reach out if you have any questions. Thanks for joining us.
And Eric, we are doing another recording in a couple of weeks. Who are we interviewing?
Oh, yes. We're going to have New Look Industrial and Infrastructure Services Fund. Really, really interesting group. They buy companies that operate in a code compliant industry. So that code compliance really brings an interesting aspect to their returns. But yeah, let's you join us for that here. And I think it's in 2 weeks or 3 weeks. But yeah, stay tuned. We'll post it.
Awesome. Thanks, Dan. Thanks, everyone. Take care.
Okay.